Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Scholastic Corporation quarterly report. Scholastic Corporation offers a wide range of businesses and services that cater to children's educational needs. The company publishes and distributes children's books, including original publications such as Harry Potter and The Hunger Games, as well as licensed properties like Peppa Pig and Pokémon. In addition to book publishing, Scholastic also provides educational solutions through its Education Solutions segment. This includes classroom magazines, supplemental materials, and programs that support teachers in their classrooms. The company also offers print and online reference products, as well as consulting services for educators. The entertainment segment of the company is involved in developing, producing, distributing, and licensing kids and family film and television content. Scholastic's international segment publishes and distributes books in multiple languages, including English, Hindi, and French, and supplies original and licensed children's books to schools and libraries around the world. Furthermore, Scholastic operates school-based marketing channels and provides supplemental educational materials, including professional books for teachers. The company also distributes its products and services directly to schools and libraries through retail stores and the Internet. Overall, Scholastic Corporation is a leading provider of educational content and services for children worldwide. Scholastic Corporation maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Scholastic Corporation trades at a lower price-to-book ratio of 1.02 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 2.15%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of various segments within a company's operations. On the growth side, the increase in sales of digital products has been a significant contributor, with a 15% rise from the prior year. Additionally, growth in international markets has also contributed to revenue growth, with a 12% increase from the previous year. The core educational publishing segment has also performed strongly, with an 8% increase in revenue from the prior year. Furthermore, specific business segments such as Book Fairs US, Entertainment US, and International Entertainment have shown significant growth, with increases ranging from $2 million to $39.7 million. On the decline side, the children's book publishing and distribution segment has experienced a revenue decrease of $5.7 million due to lower trade channel revenues. The Education Solutions segment has also seen a decline in revenue, attributed to lower sales of supplemental curriculum products and subscription revenues. Lastly, the International segment has faced a decline in revenue, primarily due to lower trade channel sales in the UK and Canada, as well as education sales in New Zealand. Overall, these drivers indicate that revenue growth is largely driven by digital product sales, international markets, and specific business segments such as Book Fairs, US, and Entertainment, US. Conversely, revenue decline is attributed to lower trade channel revenues in the children's book publishing and distribution segment, Education Solutions segment, and International segment. The net income of the company underwent a significant transformation between YTD 2025 and YTD 2026. In 2025, the company reported a net loss of $17.3 million, but by 2026, this had turned into a profit of $47.3 million. This substantial change in net income is attributed to improved operating performance. However, despite the increase in net income, profit margins likely declined due to decreased net cash provided by operating activities. The cost of goods sold as a percentage of revenues also showed some improvement, decreasing from 45.3% in the prior year to 42.4% in the quarter ended February 28, 2026. The change in profit margins varied across different segments. While the children's book publishing and distribution segment saw its profit margin decline from 11.3% in 2021 to 10.5% in 2022, the education solutions segment experienced an increase in its profit margin from 12.4% in 2021 to 12.8% in 2022. The improvement in net income and the mixed trend in profit margins suggest that the company has made progress in certain areas but still faces challenges in others. The decrease in cost of goods sold as a percentage of revenues is a positive sign, indicating potential for increased profitability in the future. The company's operating cash flow status has been inconsistent across different pages of its financial reports. However, a clear picture emerges from page 34, which provides a detailed summary of the company's operating cash flow. According to this page, the company generated an operating income of $8.9 million for the quarter and $312.1 million for the 9 months ended February 28, 2026. This indicates a significant increase in segment operating income over the period. Furthermore, despite not having information on the net change in working capital, the overall trend suggests that the company is generating positive operating cash flow. In conclusion, based on the data provided on page 34, it can be inferred that the company is indeed generating positive operating cash flow, with a notable increase in segment operating income for both the quarter and 9 months ended February 28, 2026. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt decreased substantially from $280.8 million to $5.6 million between February 28, 2025 and February 28, 2026. This reduction in debt is attributed to repayments of borrowings under the U.S. credit agreement. As a result of this decrease in debt, the company's interest expenses have also decreased. Specifically, the interest expense dropped by $4.7 million over 3 months and $13.4 million over 9 months between periods. This reduction in interest expenses is likely due to the lower amount of outstanding debt. Overall, these changes suggest that the company has made significant progress in managing its debt levels and associated interest expenses. The company's performance varied across different segments and regions. On a positive note, education solutions in the U.S., major international markets, trade U.S., children's book publishing and distribution through school reading events, entertainment segment, and Asia all performed well. The latter saw an increase of $1.8 million in local currency revenues due to higher trade and education sales. In contrast, several segments and regions struggled. Children's book publishing and distribution experienced a decline in school-based book club and book fair channels. The entertainment segment faced declines in both the U.S. and international markets. Education Solutions was also impacted by a challenging funding market for schools and districts. Additionally, supplemental curriculum products, magazines plus subscription revenues, and sponsored programs saw relatively consistent but non-increasing revenues. The company's performance in various regions was also uneven. Australia and New Zealand experienced a decline of $0.9 million in local currency revenues. Canada saw a decrease of $2.8 million due to lower book clubs and trade channel sales. The UK had mixed results, with a quarterly decline of $1.7 million, but an increase of $0.7 million for the 9 months. Management is optimistic about the company's outlook, citing several key points. The company's seasonal nature due to its school year-based operations presents both opportunities and challenges. However, management has taken steps to mitigate this by making strategic acquisitions in the entertainment segment, expanding their reach, and diversifying their revenue streams. In terms of financial strategy, management is prioritizing liquidity and flexibility. They are investing excess cash in short-term investments that earn competitive interest rates, which allows them to maintain a stable financial position. Additionally, they have secured sufficient funding through the U.S. credit agreement, providing them with the necessary resources to manage their business operations effectively. Management also highlighted their strong presence in the children's book publishing business, thanks to their equity interest. This segment has been performing well, generating income from equity investments. Overall, management's comments suggest a focus on strategic growth, financial prudence, and adaptability in response to changing market conditions. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done consistently over the past 2 years. In fact, the company declared a quarterly cash dividend on March 18, 2026, indicating its commitment to sharing profits with its investors. In addition to paying dividends, the company has also been actively buying back shares from the market. This is evident from the significant amount of $127.2 million repurchased in the 9 months ended February 28, 2026. This move not only boosts shareholder value, but also demonstrates the company's confidence in its financials and future prospects. That concludes the financial summary for Scholastic Corporation. Feel free to comment below, and I will be happy to answer them when possible.